If you currently have money in a United States bank, this is no longer a question of convenience or earning a slightly higher interest rate. This is about whether your money could be frozen, whether your cash flow could be interrupted, and whether that disruption could trigger a chain of financial consequences that most depositors never anticipate. From the perspective of someone who has closely followed how Warren Buffett evaluates systemic risk, the most alarming issue is not any single bank. It is that most depositors have no idea where their bank actually stands within the broader risk landscape. In recent weeks, what was once hidden behind technical reports and bureaucratic language has begun to surface. The internal watch list of the Federal Deposit Insurance Corporation, which tracks banks approaching failure, is no longer a rumor. Dozens of institutions have been quietly downgraded without clear warnings to depositors, while internal risks continue to accumulate. At the same time, commercial real estate is starting to crack. Unrealized securities losses are growing larger with each interest rate movement. And deposits are leaving regional banks, not in the sudden rush, but steadily and persistently, slowly tightening liquidity from the inside. What makes this dangerous is that it is happening quietly. While the system still appears stable on the surface, after each analysis, the same question keeps returning. If these banks are this risky, where should money actually be placed? Not to maximize returns, but to ensure it is still there when it is needed. From a Buffett-style perspective, the answer is not found in advertising, polished apps, or short-term incentives. It lies in the long-term resilience of a bank balance sheet. One common mistake, which Buffett has long warned against indirectly, is assuming that deposit insurance makes all banks effectively the same. In reality, this is not true. When a bank fails, the issue is not only whether you are eventually reimbursed. It is the disruption, accounts frozen, paychecks delayed, mortgage payments rejected, credit scores damaged, an entire personal financial system thrown into chaos. Deposit insurance may restore the money, but it cannot undo the downstream consequences. That is why Warren Buffett, despite having virtually unlimited resources, is extremely selective about the financial institutions he trusts. For more than 60 years, he has studied banks as a business. He understands that banking is a business of trust, discipline, and risk management. Banks earn money from interest spreads, but the true risk of loans often only becomes visible when the economic cycle turns. The strongest banks do not maximize short-term profits. They maintain capital well above minimum requirements. They diversify their loan portfolios. They tightly control commercial real estate exposure. And they build deposit bases strong enough that customers do not leave for small interest rate differences. These are the same qualities valued most highly by bank regulators. Using these principles, identifying the safest banks in the United States is not about picking famous names. It is about systematically eliminating institutions that lack shock resistance, capital ratios far above regulatory minimums, controlled commercial real estate concentration, the ability to absorb unrealized securities losses, stable deposit flows, and most importantly, management quality and organizational culture. Within this framework, JP Morgan Chase stands out not merely because of size, but because of philosophy. With a common equity Tier 1 ratio above 15%, controlled risk exposure, and enormous capital reserves, the bank fits precisely the profile Buffett respects. Under the leadership of Jamie Dimon, JP Morgan has accepted criticism for conservatism in exchange for balance sheet strength. History confirms this approach. In 2008, while competitors collapsed, JP Morgan was strong enough to acquire distressed assets. In 2023, when regional banks failed, it again acted as a buyer of last resort, helping stabilize the system. A bank that rescues others in a crisis is rarely the one that needs rescuing. With more than $2 trillion in deposits, global operations, leading technology infrastructure, and systemically important status. It enjoys protection far beyond deposit insurance. From a Warren Buffett perspective, this is the true definition of a safe bank. Not one that never faces risk, but one designed to survive when risk inevitably arrives. If one were forced to choose only a single bank to hold their money, then through the lens of Warren Buffett, J.P. Morgan Chase would clearly sit at the very top of the list. Immediately after that, the next institution worthy of serious consideration is Bank of America, a bank in which Buffett placed enormous confidence after the financial crisis of 2008 and one he held in his portfolio for more than a decade, before recently reducing his position. Many people ask an obvious question. If Bank of America is truly this safe, why would Buffett sell its stock? The answer reveals a distinction that Buffett has always emphasized: the difference between investment returns and deposit safety. Buffett did not reduce his position because he feared the bank was weakening. He did so because he believed the stock price had reached a full and possibly maximum reasonable valuation. That decision reflected an investment judgment, not a verdict on the bank's stability. In reality, Bank of America remains one of the strongest pillars of the United States financial system. Its common equity Tier 1 capital ratio remains above 11%, providing a substantial buffer against unexpected shocks. Its deposit base of more than $1.9 trillion is remarkably stable because most of it comes from long-standing retail and commercial relationships rather than volatile institutional funding. Its commercial real estate exposure is carefully managed across regions and property types. And while unrealized securities losses are not insignificant, they are supported by a capital base large enough to absorb them without threatening solvency. Bank of America also benefits from a well-known dynamic during periods of stress, often described as a flight to safety. When regional banks show signs of weakness, deposits tend to move toward the largest institutions perceived as too important to fail. Rather than being harmed, Bank of America has strengthened its competitive position, gaining deposits. Even the smaller rivals are forced to contract. The next safest bank on the list is Wells Fargo, a name long associated with scandal and reputational damage, past misconduct involving fake accounts, and consumer abuse led the Federal Reserve to impose asset caps that severely restricted growth. But this situation is often misunderstood. What many overlook is that these regulatory constraints, while punitive in nature, have made Wells Fargo safer for depositors today because the bank cannot grow aggressively. It cannot take on the excessive risks that trapped many regional competitors. Wells Fargo has been forced to focus on core operations, strengthen risk management, and build capital rather than chase expansion. The result is a much stronger balance sheet with a common equity Tier 1 ratio above 11%, commercial real estate exposure well below dangerous levels, and one of the strongest deposit gathering systems in the country. Wells Fargo is also one of 4 global systemically important banks in the United States, which means it faces the highest level of regulatory scrutiny and benefits from implicit government support. Its remaining challenges are operational and cultural, not balance sheet related. And operational problems, history shows, can be corrected over time. Wells Fargo has demonstrated this. Quarter by quarter, the next safest institution may surprise many people because it is not a traditional bank at all. It is Charles Schwab, a massive brokerage firm that also operates one of the largest banking systems in the country. During the banking turmoil of 2023, Schwab faced intense pressure as investors worried about unrealized securities losses. Its stock price fell sharply, and headlines questioned its stability. Yet those concerns missed a critical point. Schwab's business model is fundamentally different in ways that create extraordinary resilience. Most of its deposits are cash waiting to be invested. Inside brokerage accounts, clients hold money at Schwab not to earn yield, but to facilitate transactions. That behavior creates a uniquely stable deposit base. Even when savings rates are not competitive, clients are not searching for the highest yield. They are simply moving money between investments. This sharply reduces withdrawal pressure compared to traditional savings banks. In addition, Schwab has actively managed its securities portfolio, allowing lower yielding assets to mature and be reinvested at higher current rates. Unrealized losses, while still visible on paper, have been shrinking. Each quarter, over a 2 to 3 year horizon, this issue is likely to resolve naturally, as long as Schwab maintains sufficient liquidity to avoid forced selling, and its liquidity position is extremely strong. It is supported by access to Federal Home Loan Bank facilities and a parent company with multiple funding sources. Schwab also offers something traditional banks cannot match: brokerage asset protection, combined with bank deposit insurance for clients who keep both investments and cash at Schwab. This creates multiple layers of protection beyond what most banks provide. For investors seeking to consolidate their financial lives within a single institution without sacrificing safety, Charles Schwab is an excellent choice. The fifth safest bank is U.S. Bank, headquartered in Minneapolis, an institution that has quietly built one of the strongest regional brands while competitors collapsed. U.S. Bank has long been known for conservative management, disciplined growth, and a refusal to pursue the risky loans that destroyed many peers. Its common equity Tier 1 ratio remains above 10%. Its commercial real estate portfolio is carefully diversified by property type and geography, with particular strength in the Midwest, a region that has proven more resilient than coastal cities suffering severe office vacancies. Its deposit base comes primarily from consumers and small businesses, the most stable and reliable funding source any bank can have. Unlike institutions on the Federal Deposit Insurance Corporation watch list, U.S. Bank has not experienced significant deposit outflows. Clients stay because they trust the institution, value long-term relationships, and are unwilling to trade service quality for slightly higher yields at riskier competitors. U.S. Bank also operates critical payment processing and corporate trust businesses, which generate steady fee income. Regardless of interest rate cycles, this diversification means its earnings are less volatile than pure lenders, adding another buffer against unexpected losses. At this point, a question naturally arises. For many listeners, what about Citi and other massive banks that appear too large to fail? The answer, true to Buffett's philosophy, requires nuance and a careful distinction between size, profitability, and genuine safety. And this is exactly where the discussion becomes less comfortable. In the same way Warren Buffett has always viewed the world, Citigroup, by sheer scale, is clearly a globally, systemically important institution. There is little doubt that if Citi were ever in real danger, the United States government would be forced to step in. In that narrow sense, deposits held at Citi are unlikely to simply disappear overnight. But Buffett has never evaluated safety based only on the likelihood of a bailout. He looks deeper, more coldly, and more realistically The core issue with Citigroup is not capital size. It is years of persistent management and operational weaknesses. Those weaknesses have resulted in ongoing regulatory restrictions, consent orders, and limits on business expansion that have never been fully resolved. A bank can be too large to be allowed to fail, but that does not mean it is being run in the best possible way for depositors. Buffett understands a harsh truth. Weak management, if allowed to persist long enough, creates risks that even strong capital cannot permanently offset. He would not tell you to avoid Citigroup entirely, but he would also not place it among the 5 safest banking fortresses, especially when better alternatives exist. The same logic applies to Goldman Sachs and Morgan Stanley. These are elite financial institutions, exceptional at investment banking and asset management, but their core businesses are not traditional deposit banking. They serve specific purposes very well, often for sophisticated investors, but for the average American seeking maximum safety for cash, they are not the primary banking relationships. Buffett would recommend. This is also why several familiar regional banks do not appear on the safest list. Despite their strong reputations, Truist and Capital One are widely used and appear solid on the surface compared to small community banks that are failing across the country. They are certainly safer. But compared to the top tier institutions, their risk profile is meaningfully higher. PNC carries greater exposure to commercial real estate than banks like J.P. Morgan or Bank of America. Truist was formed through a merger, completed at an unfortunate moment, leading to integration challenges, securities losses, and forced asset sales to rebuild capital. Capital One is fundamentally a credit card company with banking attached. If unemployment rises sharply, its consumer loan portfolio would face direct pressure. These are not bad banks. They are not on failure watch lists, but they are not fortresses. And when deciding where to anchor your entire financial life, Buffett would be very direct. Choose the strongest institutions available, not those that merely seem acceptable. Buffett evaluates banks the same way he evaluates businesses. He looks for what he calls an economic moat. In banking, the deepest moat is not high yields. It is a stable, low-cost deposit base built on trust and long-term relationships, not on interest rate competition. When customers stay because they trust the bank, because they value the service, and because leaving would be inconvenient. The bank owns something that competitors cannot easily copy. All 5 institutions on the safest list have built this advantage over decades, and in some cases centuries. J.P. Morgan traces its roots to the late 1800s, Bank of America to the early 1900s. Wells Fargo has survived nearly every major crisis of modern American history. They endured world wars, economic depressions, financial collapses, and repeated market cycles. They will survive the current regional banking stress. In fact, following Buffett logic, they may emerge stronger, absorbing deposits and assets from weaker competitors. At attractive prices, Buffett has always emphasized one principle. In banking, reputation matters more than short-term profits. A bank can recover from loan losses. It can recover from bad investments. It can even recover from scandals and regulatory penalties. But once depositor trust is lost, collapse happens quickly. When fear spreads, money leaves before logic can react. That is why the safest banks invest heavily in maintaining stability signals, projecting strength, and reinforcing depositor confidence. When crisis hits, deposits flow toward them, not away from them. So what should you do with this information? Buffett would not sugarcoat the answer. First, look honestly at where your money sits. List every account, every bank, checking savings, certificates of deposit, money market accounts, Compare each total to the Federal Deposit Insurance Corporation limit of $250,000. If any institution holds more than $200,000 of your money, you are taking unnecessary risk, regardless of how safe it appears. Second, evaluate each bank using hard metrics. Common equity tier 1 capital, commercial real estate concentration, unrealized securities losses, deposit outflows over recent months. All of this data is publicly available in quarterly filings and Federal Deposit Insurance Corporation tools. Third, consider consolidating your primary banking relationship with the strongest institutions: J.P. Morgan Chase, Bank of America, Wells Fargo, Charles Schwab, U.S. Bank. Less flashy, often lower yields, but far safer. You may give up a few percentage points, but as Buffett has taught for decades, not losing money matters more than making extra money. Higher yield means nothing if your bank fails and your financial life is frozen when you need it most. Finally, remember this: safety is not a one-time decision. It is an ongoing discipline. Those who survive and compound wealth across crises do not predict the future. They prepare for the worst case. Warren Buffett has done this his entire life, and you can apply the same philosophy today, starting with where your money is held right now